Hi, today's my class is related to features of investment. In the previous class, I have covered 5 features of investment. Today, I am going to continue the part of features of investment. Let me start with the capital appreciation. Capital appreciation refers to an increase in the market price of an investment. If you are invested 10,000 1 year back and if its value at present is 15,000, then it is considered as a appreciation in capital, appreciation in your investment. If you are 1 year back, if you are deposited 10,000 in bank at 5% rate of interest, after 1 year your capital amount increased by 500 rupees, so you are going to get 10,500. So that's called as an increase in the market price of an investment. If you are bought one particular company shares at rupees 100 last year, and if its value at present is 200 per share, then 100 rupees increase in the value of a capital is called as a capital appreciation. Every investor intention is to increase the capital or to appreciate the capital. That is either in safer zone or in case of a high risky zone. The everyone expectation is to increase the capital appreciation. So it is calculated at the time of disposal of an investment as the difference between the selling price and the purchase price of investment. When you come to know whether your capital is appreciated or not, or that is calculated at the time of selling it, or at the time of encashing it, or at the time of maturity, then you come to know what is the value of capital appreciated in your portfolio. So that is it will calculated at the time of disposal of an investment as a difference between selling price and purchase price. If you are last year, if you have purchased a land for rupees 10 lakh and if you are selling it in current year for rupees 12 lakh, then that particular 2 lakh increase in the value of land is considered as a capital appreciation. So that is calculated at the time of selling. The difference between purchase price and selling price is considered as a capital appreciation or value of capital appreciation. Capital appreciation may occur in a variety of investments such as equity, or in case of mutual funds, real estate, gold or other commodity or tradable investments in any sector. So in almost all the investment avenues there is a capital. You can calculate the capital appreciation by comparing your investment and your return, the some maturity value. So that is the difference between investment value and maturity value is considered as a appreciation in the capital. So always investment generates capital appreciation and income generation. That's the two part in case of investment. Capital appreciation increase in case of value of your capital, and it generate income also investment. So you can consider every month or every year, every time it generate the incomes. That is depends on again your investment avenue. So that's all about capital appreciation. So next feature of investment is a market for trading. So it is one of the main feature of the investment. So whenever you take the decision of investment, you have to consider whether you are going to investing or whether your intention is a trading. Some class of investment avenues or some investment schemes have the feature of trading, and some investment schemes does not have the feature of trading. They are only considered as investing, and then that they are considered as trading. What means trading? Like once after you buying it, and if you want to sell it, then if there is a person, if there is a buyer to buy your assets, then it's called as a trading. Like gold, if after buying the gold, if you want to sell it, you can easily sell it because there is availability of buyer. So then you can trade the gold. And land also, after investing some amount in land, you can sell it at any time because there is availability of buyer. You can trade the land, or even you can trade in case of securities, or even in case of bonds, or even in options or derivatives market. There you can trade. So that's called as a investing and trading. And then where there is no trading, in case of bank FDs or postal schemes, or in case of LIC schemes, they cannot be traded. Means if you are deposited 10,000 in the bank, and you will get bank certificate, and so that certificate cannot be transferred or in the market. There is no buyer for such particular certificates. If you want to get that particular amount, then you have to return it to the banker. Means you have to encash in the through the banker itself. You cannot sell it in the market. Even in case of LIC policies, once if you borrow the LIC policies, then bond cannot be tradable in the market. So therefore they are considered as a investing, whereas some investment avenues are considered as a trading. Like in case of securities, if you borrow the securities in the stock market, then you can sell it because there is a market for trading in case of securities. Or even in case of bullion market also, you can trade it in case of bullions also. So there are a lot of investment avenues which carries the nature of trading, and some investment avenues which does not carry the nature of trading. So it's called as a market for trading. So that is your decision, investor decision. They have to take the decision based on whether they are going to trading or whether their intention is only investing. On the basis of that, you can select the investment avenues. Both are positive, both are good for the investor, both will provide the income. When both in case of investing as well as trading, the investor will get the income, and that depends upon their skill. The risk is there in both the sector, and that has to be analyzed. So that is about market for trading. So next feature of investment is a transaction cost. Transaction costs are expenses incurred when buying or selling a goods or service. Transaction costs represent the labor required to bring a goods or service to market, giving rise to entire industries dedicated to facilitating exchanges. In a financial sense, transaction cost includes broker's commission and spreads, which are the differences between the price the dealer paid for security and the price the buyer pays. The transaction costs to buyers and the sellers are the payments that banks and brokers receive for their roles. There are also transaction costs in buying and selling real estate, which include agents' commission and closing costs, such as title search fees, appraisal fees, and the government fees. Another type of transaction cost is the time and the labor associated with transporting goods or commodities across long distances. Transaction costs are important to investor because they are one of the key determinants of net returns. Conclusion: transaction cost means in investment is the cost which included like brokers commission or brokerage or taxes or security transaction taxes. These are considered registration fees. These are considered as a transaction cost, and it is there in investment. So you have to select the investment avenues which carries the minimum transaction cost or which carries a zero transaction cost. For example, for the transaction cost, if you want to buy the land, then you have to pay the registration fees or other charges like government other fees or the other costs of the government you have to pay, and you have to pay the commission to the brokers also. So therefore, there involves transaction cost. It is a high transaction cost. And when you go for the stock market, there also transaction cost includes brokerage at the time of buying as well as selling, either in day trading or in case of long term or in case of derivatives market, there is a transaction cost. So it is in the form of brokerage or security transaction duties or stamp charges. So that's called as a transaction cost. It is there in case of stock market, it is there in case of real estate, and it is there even in case of gold. So whenever you buy the gold, then it carries the transaction cost. At the time of trading in case of gold, it carries the transaction cost. When you go for the bank as investment avenue, if you deposit some amount in the bank as FD or RD, then it carries zero transaction cost. There is no charges. You can easily deposit the amount in bank as FD for 5 years or 3 years or 1 year for any number of years. For that, the banker is not charging any amount. So that the transaction cost is zero. They are not collecting any charges. Even in case of LICs also, there is no transaction cost. So what the LIC is not charging any fees for the premium paid or whatever amount at the time of opening of LIC policies. There is no additional fees or any other charges or commission or agent's commission that is not included in case of LIC policies. Even in case of schemes of the postal department, you can easily borrow without incurring any expenses, zero expenses. So that's called as a concept of transaction cost. So it is there in investment avenues. It differs from avenue to avenue. So where there is a zero risk, then there the cost is also less. So in bank, there is no transaction cost. In postal department, no transaction cost. In LIC, no transaction cost. When you go for the mutual fund, there is a minimum transaction cost. When you go for the real estate, then there is a transaction cost. When you go for a gold, then there is a transaction cost. Or when you go for the stock market, then there is a transaction cost. Or even in case of gambling also, there is a transaction cost. So that is called as a transaction cost. It is a feature of investment. And why it is considered, why it has to be considered, because your selection should be based on the transaction cost, because it will affect on your return. So while you are considering the return, you have to deduct all these transaction costs, then you have to consider net return. So therefore it is a key determinants of net returns. While you are calculating the net returns, you have to consider the transaction cost. Like you have deposited 5,000 in bank and 5% rate of interest, you are going to get 250. So your total return amount is 5,250. Investment amount plus 250 rupees a return. So you are going to get that particular amount. But same amount if you are deposited in case of if you are invested in stock market, then you will get 250. You will not get the 250 rupees. You will get the amount after deducting some cost, some transaction cost. So that is called as a transaction cost. So it is there in investment avenues. So next feature of the investment is timing the purchase and sale. Yes, student, this is the important points in case of investment. Your success is depends on when you purchased the particular investment avenue and when you sold it. So on the basis of that, your return is dependent. So your return or the uh, appreciation in case of capital is always dependent on when you purchased that particular security and when you sold it. Say for example, you purchased one particular security today in the stock market for rupees 100, and tomorrow its value is 200. You sold it day after tomorrow, its price increased to 300. Is one example. And another example, you purchased it for rupees 100 and after 1 week its value increased to 200 and you are not sold it. You waited for long term and after 1 month its value decreased to 10 rupees. Now you will get the confusion when to buy and when to sell the security. So that is a very important timing. You have to, while analyzing the risk, you have to analyze the time factor in case of investment. Not only in case of stock market, even in case of real estate, even in case of gold, it is not easy to analyze the time. Analyzing the time means when the price will increase and when the price will decrease, when which is the right time to buy and which is the right time to sell. So when you go for the bank FDs or postal schemes, it is less important, it carries less importance, but there also the rate of interest fluctuate always. So earlier it was 9%, now the rate of interest is 5%, now reduced rate of interest. Then you can wait for a long time. In the future it's uncertain. We don't know whether the rate of interest increase in the future or not. So that is depends on the government or depends on the economic conditions. So timing the purchase and sale plays a major role in a investment avenue. So that for that purpose you have to study why time in the market is better than timing the market. So time in the market is a better than timing the market. That's plays major role. So it may change at any time. So that is the nature of the market, investment avenues or investment market. A timing the market is a full game. whereas the time in the market is your greatest natural advantage. Waiting for the market, timing the market is a full game, whereas assessing the time in the market is your greatest natural advantage. You have to wait for right time, means you have to assess the time and you have to buy it in the right time and you have to buy it in this sell it in the right time, so then you can enjoy the good profit. So that is about timing the purchase, when you have to buy the land and when you have to sell it, and you have to sell it in the right time, at the same time you have to buy the land in the right time, then you can enjoy the benefit of investment. So when you go for concept of because our purpose is here investment purpose is to get the good return, and if you want to get good return, then you have to assess the time. While assessing the risk factor, you have to assess the time. So risk factor is dependent on the time, or these are correlated, the risk factors, timing factors, so that will all influence on your return, or your return is always based on all these factors in the investment avenues, and you have to analyze it and you have to compare it, and then you have to take the decision of investment, either purchasing or sale. So that's about timing the purchase and sale. The next feature of investment is a passion investment. These investments are items that they are passionate about, enjoying owning, all while making money from them as the value of these items appreciate over time. Investing in non-traditional assets you are passionate about is known as passion investing. Passion investment means, in simple words, that some class of people have the passion of buying some vintage vehicles or any vintage products. Uh, they buy it for the purpose of passion or habits of buying it, like collection of coins, collection of stamps. So it is their habits. Even some peoples have the habit of buying the t-shirts of some top players in case of different field, either in cricket or in case of sports. They will buy through the auction and they will keep it with them for long time. Or buying some vintage cars, vintage vehicles, or vintage motorbikes. The people have the habit, they borrow it, they invest more on such items, or any even in case of stamps also, the people have the habit of collecting the stamps by paying more, investing more. You can see that even in case of through OLX or other online market, you can see that the coins are selling at a higher price. The people's, some class of peoples, they buy it at a higher price, they invest more. Even in for the painting also, they buy it as their passion, buy it there for their habit, not to get the return. So that's called as a passion investing or passion investment. So that the investment or the habits which you made or which has been cultivated by the investor, in the future days, whenever any financial crisis occurs to the particular investor, any financial problems occur to the investor, then they can sell it to the other persons, like the coins which you have collected from so many years. And if you have any funding problems, any financial problems in the crucial stage, you can sell it in the market. There are other persons who borrow it by paying higher charges. Like in case of vintage cars, vintage vehicles, if you have any vintage cars or vintage motorbikes from so many years, and if you want any financial, if you want to solve your financial problem right now, you can sell it in the market. The persons will, at present there are a lot of people, they will borrow such class of motor cars or even in case of motorbikes by paying the higher value. So that's there you are going to get a higher return. See here, the purpose of buying these all is not investment, but you can convert it as an investment in the future. So that's called as a passion investment. The passion investments, an asset class that won't put you to sleep. So that is an asset class that won't put you sleep, means you borrowed it as an habit, it's a passion, you want that particular, so therefore you saved some amount from your earnings and then you have deposited it somewhere, and after getting some multiple values, then you purchase such class of assets. That's why it is called as an asset class that won't put you to sleep. You have the planning of buying that particular vintage cars or vintage vehicles, or any some kinds of other articles, or in case of stamps, or in case of coins, or even in case of any other paintings. You are passionate about that, so therefore you have purchased it, but later you are going to sell it due to some financial crisis or financial problems. So a collectible item from a hobby that increases in value and due to rarity and popularity. It rarely, like, there are a lot of example, you know, that about the passion item or vintage items, vintage coins or articles. The people's, there are a lot of people have the habit of buying it, and originates when a person wants to unite a hobby with the speculation. So that originates when a person wants to unite a hobby with the speculation. So in the future days he can make it as an auction, or he can use that investment as a uh, to get some fund. He can convert it into cash whenever there is a financial problem. Generally the people use it as investment avenue whenever they have the financial problem, otherwise they won't touch such type of investment or such type of habits. They are not ready to sacrifice it in the future, even in a crucial financial problem. So that's all about the passion investment. So these are the different features of investment, and I have explained the first 5 features in the previous class, and the remaining features I explained in today's class. So that's all about different features of investment. After studying the meaning, definitions and features of investment, I hope that you understood some concept of investment, and which is also applicable for your life. While after joining any employment, after starting your earning, so take the proper decision of investment, properly analyze the different investment avenues and properly invest it, because it is your earnings, your savings, your hard cash, and there should not be any risk for your investment or capital. While at the time of getting more return, or with the expectation of more return, you should not lose your entire capital, because ultimately it stands your earnings, your surplus, your savings, your hard cash. So you should not lose that while taking the decision of investment. So that is called as a risk factor or a risk management. So it is applicable to your life. So save some part of your earnings, save some part of your revenue, and generate more capital in the future, and it will help you to fulfill your desires in the future. You can meet your different expense plans or desires. So desires or your plans can be fulfilled 99% through the cash, or the cash or money will help you to fulfill your desires, like buying of any motor car, buying of house. It is not possible within your salary. So in such cases you have to invest somewhere where there is a good return, and where there is a less risk for your investment amount, for capital amount. So therefore this plays a major role in each and every person's life. So therefore success and failure of the person is dependent on how they manage their cash, how they manage their fund, or how much investment avenues they have, or how they took the investment decision. Otherwise we call such persons, if he is not in a position to manage the life, the failed persons are called as insolvent in the life. Insolvent in the life means they are not in a position to manage the money or manage the cash. They does not have any schemes in their investment. It is you are having different type of schemes in your pocket. Investment is considered as a pocket, and you must have different number of investment schemes in your pocket, and which will help you to solve your financial problems in the future, either short term or long term financial problems. So that's all about the investment. Thank you for watching. Thank you very much.